let's just go ahead and talk about some things that we've done here recently. We talked earlier about in the beginning of the presentation, we talked about the married put approach, what we do, buying stock, buying a put option in the money to keep risk to single digits. And then we use a variety of 13 different income methods against those positions. And that's described in our full course here, the blueprint, the proper structure, criteria that we prefer to use, how and when to apply those various different income methods. And what are the income methods? Well, I have a stock and I have a put option. So naturally I can just sell a call. I can adjust the put. There's 5 ways to adjust the put essentially, which is a second working asset in our favor. And the idea behind the income methods is as I generate income or adjust the risk reward profile of the trade, I'm lowering the risk on the position. So eventually I can have no risk and have a bulletproof trade going forward. And I did open a new married put this week. I was going to open a second married put as well. I held off for a moment just due to some of the things that were going on this week economically. But our default search is shown for you here, radioactive by earnings per share growth. There's that Robinhood again. I just never trust it, but it came up in my bull puts and it's coming up here. I haven't had luck with it a few times. I've traded Chewy. I've had a good one with Ernie's currently in Toast, TOST, I'm sorry. And that's at the Fusion portfolio at radioactive trading. There's that Celestica again. It's been on a good tear, but then had a pullback, I believe, and then is going back up again. JBill Circuits is not in here, but it's one I've been looking at too. There's Roblox. My daughters want me to enter that trade. I don't think I'm going to. I don't trust it too well. Let's take a look at I'm going to take a look at the chart. This wasn't working earlier, by the way, but we might go to big chart or stock charts. Okay. Yeah. Big charts is down. So let's go ahead and take a look at stock charts there. Yeah, it's been strong, but for a married put position, I want to see here the MACD is starting to convert. I want to wait a little bit for a different bottom there. And you see with the ads that pop up, this is why I prefer not to use the stock charts one. But a very strong run. It's been extremely strong. And yeah, I think my daughters wanted me to enter it at 70, and I missed that opportunity. Listen to your daughters more, I guess. But the one I was looking for actually isn't here right now. It's still not on the list. This doesn't match the criteria. I just recently opened one on Caesars. It actually was from my personal search, differs a little bit from this one, but the one I was going to open this week was Affirm Technologies, and I don't see it on here. So I'll have to look at this new list. So I'm going to open a new trade there for the married put portfolio as well. All right. Okay, so I just wanted to talk about this briefly because we did make some new trades, as I mentioned. Sorry, I used my criteria, but what we've got here now, ignore this on long put. That's actually a married put right now. It's currently at about a 7.8% return. I did some fun income methods with that one that I almost did with Planet Fitness. So right now in Planet Fitness, I've got the 110 call. I sold a week ago at 240. It's at the same price. The stock has dropped down to 105.70 and it has moved up to hit 110.20 today or 110.30 and then pulled back from that. So, you know, I'm in this collar position here, but I've lowered the risk on that. LTH we made an adjustment with, but Caesars Entertainment is the new one. It's doing exactly what I want. In the first 4 days of the trade, it's up 3%. So my liquidation value is at 0.1. It's actually about 1% at true midpoint if I liquidated, but that's not the goal. So we bought the stock at 28.03, sold the 31 put, did miss an opportunity. It had a gap up to about 29.90. I should have sold the 31 call then, but I didn't. That was my fault. But again, you know, so there's some of the positions there, and the Planet Fitness is not bulletproof yet, but we have reduced the risk greatly, looking at a 6% potential return on the stock. And right now, I think the liquidation, as you saw, was about 5.25. No, it's about 4.8, 4.9 at expiration if the stock stays where it is, about 5.2. And this is a long-term married put. I'm out to November. I think I moved this put further out. I should actually roll this put up to the 110, and I'd cut the risk down to about 1%, the most I could lose on the position, even if the stock went to $1 per share. So that's the married put in a nutshell there, and using the different techniques also. And you can see some more basic information on that, of course. You just go under the married put tab, and go to the Learning Center, and you can see Ernie's 4-part article here, the cover called Challenge, Limited Risk Solution, Married Put and Collar Strategy, and of course the sketch is a free 9-page white paper introducing the married put and the different income methods, but the full course is only described in the blueprint as well. A comment came in. This is, even though you just opened this Caesar's position and it's up 3% as you expected in the first 4 days, that's for the married put, that's my expectation. Would you close now, or would you do an income method? All right, excellent. Well, the key here is that I wouldn't liquidate right now. Okay, I could take a 0.7% liquidation return for 4 days. This isn't the strategy I'm looking to make those kind of returns with. I'm in longer term growth. My goal, our goal, I should say, when we open one of these married put positions, I'm looking for a position that will move up 3 to 6% in the first 20 to 40 days, with the potential to move up another 4, 5, or 6% in the following sort of 40 to 50 days after that. So this is matching what I want. Could I generate income right now in this position using one of the 13 income methods? I could, but right now is not the time. I could have 2 days ago, knock on wood, as I mentioned, I should have sold the 31 call for either 2 weeks out. I was looking at 3 weeks, but I wanted to do the 2 week out. But I have a certain requirement that I personally like to use. Now, right now, if I go, anytime you're tracking a position in the portfolio, mind you, as I'm tracking my married puts here, I can go to position actions and then position analysis. This is going to give me a breakdown of my current position, where I stand right now. I can look at more details. So yeah, I know I've got a 0.7% return. I saw that in my portfolio by selecting the stock analysis view for the extra 6 columns of original cost, expected return, current liquidation value, and future expiration value if the stock remains at the same price. So this is not my end goal for this position. I'm in this for the longer term, as you might be with a diagonal calendar spread or something along those lines, even at long-term out-of-the-money covered calls we talked about a little bit earlier. Now, yes, the stock is below my put strike price, so if I hold this position all the way to expiration, do no adjustments, accept no dividends, and the stock stays below my put strike price, yeah, I'm going to lose the 7.5% maximum risk. If the stock drops to $1 per share tomorrow, next week, the most I can lose is 7.5%. It's guaranteed. But now I see there's no rollout opportunities that meet my criteria. And even though the stock is up 3% in 4 days, why it's showing that is because my put is at such a higher strike. The rollout opportunities you see for a married put here are based on the rules in the blueprint for the full 13 different income methods that we use. And the return I would get, even going 25 or 30 days out in time, by selling a call the correct way in the married put position, is not giving me the desired return. Let's take a look. Oh, sorry about that, folks. Let's take a look here. And let's go to position. Let's go to profit and loss chart. So you say, okay, well, your stock moved up as you wanted. You bought it at 28.03. It's trading at 28.86. Okay, you've got the 31 put, but you're right at the money. Why not sell a 29 or 30 strike call? Okay, well, part of the reason why is because that could get me into trouble. Remember, my maximum risk here is 7.5%, $253 in the worst case scenario. 203 days from now, assuming I make no adjustments, accept no dividends, and Caesars is trading below $31 per share. But okay, let me go ahead and sell a call. Let's go 2 weeks out. Let's go to that July 11th. And yeah, the 20, that zero there. Wide bid-ask spread here. This is more realistic at the 30 strike, getting 49 cents. Let's go ahead and do that. All right, so we're going to reduce our risk by about 50 cents at midpoint, selling this 30 strike call. So we're going to see a reduction in that 7.5% risk, and we might have a small return at the peak. Oh, wait a minute. The max risk went up to 9.2%. It went up to 304. How did the maximum risk increase? Because remember, I paid for the stock and I paid for the put option for a longer term growth trade. A total investment we saw was about $33.53. With the reduction of the 50 cents, we've reduced it down, okay, 33.05, but yeah, no, 49 cents, 33.04. But I've agreed to give up my shares of stock at 30. If there is a large gap in Caesars, the maximum risk didn't increase to the downside because I lowered my cost basis. The risk increased to the upside in the direction I thought the stock was going to go, that I'm planning on the stock's going to go, which is why I opened it. Now, sure, the break even is only at 33.12. I'm talking about a 5-point movement here, almost a 20% movement in the underlying security. And I'm not expecting that in the next 14 days. But that's the problem. Yes, a good 3.7% return. Lowering the risk is good there. But I sold the call below my cost basis and below the put strike price. My risk increased to the upside in the direction I thought the stock was going to go. So that's part of the problem. That's why I'm not selling it right now. Now, the 31 would look a little bit better, but not much because the premium is so much lower. It's only, yeah, I get lucky at 19 cents. This is, I'm sorry, 98 cents, not even. This is going to be 5 cents, 10 cents at best. So yeah, I hedge it a little bit. And let's just do that. Let's just go ahead and use that 10 cent. But again, I've only reduced the risk to 7.3. Sure, I could make 4.2%, but I'm waiting. Again, I should have done it when Caesars actually came up to 30. I think it was at 29.80 is where it hit the other day. It might have actually gone above 30 when I wasn't paying attention. I was on a coaching session, so it might have gone above 30. I'm not sure. But I saw it and it had jumped, and that was 2 days after I entered the trade. I was going to sell the 31 call, and then it hesitated, and then the next day it pulled back down. It's still above, 3% gain from where we got into it. Still looking pretty good. It's doing what I want it to do, but I'm just not doing an income method now because now is not the time, based on, again, the full discussion on the blueprint. Not only the criteria that we use, the structure we use, and why we use it to control risk guaranteed. It's not assumed insurance, such as a stop order or a trailing stop. It's guaranteed insurance. Yes, we're paying the premium for it. And that premium on the Caesars position did look kind of expensive, didn't it? I increased my cost basis from 28.03 up to that cost basis of 33.53. And that's the break even. But that's the break even only if I hold the position all the way to expiration. Make no adjustments of those 13 income methods I have at my disposal in the blueprint, except no dividends. And the stock is trading below 31 at January expiration. The put doesn't go to zero when I buy it. It's just like buying a long call. It still has value, and we see that. The current midpoint is at 490. I've lost about 60 cents on the stock. I'm sorry, on the put. My apologies, folks. I've lost 60 cents on the put and gained 86 cents on the stock. Now, usually it's more of, the structure is more of a 50-50 ratio. I went not as deep in the money initially as I would have. Took the 7.5% risk to January instead of a 4% risk that I could have in December, or I could have in January as well. So I made that choice. So I know the put was going to drop. There's also, what are we experiencing right now, of course? Not experiencing, but what we're seeing. And this came in relation to the discussion with the bull put credit spreads we had earlier, and using that zero bid and also some of the in the money and out of the money covered call positions. We're getting a drop in the VIX. We're not at 19. We're not at 21. We're not at 22. Things are de-escalating globally a little bit in some areas, not in others. But the market is digesting, what's going on in the Senate with passing the bill and adjustments the Senate is making to what the House passed. Fears are abating about that. Having some other issues, the tariff issues, although the administration did mention today that they broke off negotiations with Canada. I think that was mid-afternoon, right? 2:30, 3 o'clock this afternoon. That they're stopping the economic and trade discussions with Canada. So that might increase implied volatility. The VIX, of course, globally, but also going into the markets on Monday. So that's one of the aspects there that we're seeing too. That the premiums for the calls that we might look for aren't as high as they were 4 weeks ago. Definitely not as high as they were 2 months ago, back, April 11th, April 12th, April 13th, when we had reached the bottom there, when we kind of hit that bottom of that market decline, and all the volatility that was going on, dropping from that 30 to 40 range. Let's just take a look here, and you can see it. And it's on that note, of course, maybe a little. Okay, this does it differently. Oh, okay, there we go. Now that's the VIX of the VIX. I don't think I want that, but it should be the same. And I'm sorry, this is, I don't use this one that often. So period, yeah, no, range, 3 months. There we go. Right. So the VIX here, when SPY was, really don't like stock charts. I'm sorry, folks. It's a good tool to use, but the advertisements, they keep popping up. But here, that's not the real number. This is a different one. It's the VIX of the VIX, so it's measured differently. But yeah, you can see, of course, we know our peak was in that April 11th, 12th, 13th range. Hit a bottom here, came back up, but now we're back down into this range. And so this isn't the actual VIX. This is the VIX of the VIX, but it's getting close to that point. It came back up today. If this had dropped a little bit further today, if we'd gone into the 14 range, which I didn't think we were going to, but if VIX dropped down to maybe 1450, maybe 1410 today, if there was a more decline in the VIX, which actually might have been during the day. Now it only dropped to 1612. That's what I thought. But yeah, if it hits 14, goes below 14, definitely, I'm probably buying calls on the VIX. So there's too much going on there. I think Ernie's target is below 15 when he starts buying calls on the VIX as a market hedge. I as I mentioned, I have the married puts, about 40, it's actually 50% of my portfolio is in the married puts, so I don't worry about that. It's the 15% of my portfolio that are in those bull put credit spreads I mentioned, 10 to 12% that are in diagonal calendar spreads on what you might call poor man's covered calls. I just don't like to use that term. You can see why if you go to our YouTube channel and just search across our channel in poor man's covered calls, why I don't like to use that term to define the diagonal calendar spreads. But yeah, it's just historically when it drops to those levels. Originally, back in the melt-up markets of 2021, if I saw VIX drop below 11, I was buying, 12, 15 contracts. Now the market's a little bit different. Global situation is a little bit different. We see it drop below 15, maybe below 14. Yeah, I'm buying maybe 5 or 6 calls on the VIX. Out of the money, 45, 50, maybe 60 days out in time, maybe around a 0.3 delta, maybe around a $1 cost. And if it keeps going down, I'm going to buy more at a lower strike because eventually something is going to swing. Something is going to happen. You guys have lived through it as well as I have over the past almost 3.5 years, 4 years, it seems. After the melt-up market of 2021, we had the Powell markets. 2020, of course, we came off the pandemic market. We had the melt-up market of 2021. Then we had the Powell markets. And now we're in the new administration and the tariff and trade war markets. We can call it that. But there's also global escalation of different I don't want to say wars, but yeah, let's call them what they are essentially in most places. And so that's causing the flux in volatility, flux in shipping, flux in gas prices, flux in gold as well. So, and we've got that in our pocket. So this is the lowest been in a little bit, and it's still decreasing, and the market's still going up. We're getting near those new highs again. We're at those new highs again. So it's always something to consider, a little bit extra protection of your portfolio. Hey, buy puts on SPX, buy puts on SPY, QQQ, IWM, whatever your portfolio represents, but calls on the VIX when it drops below that 15, maybe 14 level is always a good idea. Just give yourself time. You don't want to buy weekly. You don't want to buy daily. You're going far out in time to give it time because you don't know when that next event's going to happen, but we've seen it happen consistently to where it triggers a movement.